The narrative that is being pushed by the mainstream media and the Federal Reserve themselves is that they're going to achieve soft landing just like how they did in 1990s. And yes, that's true that in 1990s, Federal Reserve jacked up the rates from 3% to 5, almost 6%, and then slowly bring it down. Okay, yes, exactly that's how they did that. But there are some stark differences between 1990s and 2024, because in 1990s we did not have the yield curve inverted and we did not have the unemployment rate spiking up. These are the two main differences between 1990s and right now that makes it very different in terms of the overall economic environment. Okay, so let's get into the details. So if you look at this chart, you can see the blue line is the yield curve. Okay, it's the difference between the 2s and the 10-year treasury yield. The red line is the Federal Reserve's funds rate, and the green is unemployment. So you can see in 1990s, the Federal Reserve started, bringing the rates up from almost 3% to all the way to 6%. Okay, and gradually they were bringing it down. But you can see back then we did not have the unemployment spiking up. In fact, the unemployment rate is trending downwards since 1992 all the way to 2000. It never went up. It only started going up in dot-com bubble crash. And if you look at the yield curve as well, you can see it was never inverted in the entire period when the Federal Reserve was jacking the rates up and then slowly bringing it down. It only went inverted in 2000 and then gets uninverted just before the dot-com bubble. Versus in 2024, we can see that the yield curve is inverted right after when the Federal Reserve jacked up the rates, and then it stays inverted for almost 2 years, and now it is coming back up. It is getting uninverted, and the unemployment is also picking up. Okay, so you have to look at the trend. The trend is upward for the unemployment rate. Okay, that's the key. You have to look at the trend, not the value itself. And you can argue that, okay, Yasin, unemployment in the US is 4.3, which is pretty much very low compared to the historic values. Yes, you're right. But if you look at this chart, you can see that in each recession, the beginning of the recession, we see the unemployment was low, just like right now we have. So if you go back to the COVID, we can see the unemployment rate was 3.7 just before the COVID recession happened. If you go back to 2008, you can see the unemployment was 4.3% December 2007, just before the 2008 crisis. Going back to dot-com bubble, you can see the unemployment was what? 4%. Okay, so at the beginning of the crisis, the unemployment did not spike. It actually goes up when we are actually in recession. Okay, so having 4.3% unemployment rate and going up from a trend perspective, that itself is telling you that we may not be in recession right now, but we may be heading towards it. Because if you look at the SAM rule, that has been triggered in almost every recession in the past, and as it goes above 0.5, it always followed by a recession. Okay, so now you understand that there are some big differences between 1990s and 2024. We did not have the unemployment picking up. We did not have the yield curve inverted and then getting uninverted, which always happened because of the recession. And let's understand why the yield curve matters a lot. The yield curve matters because it has a lot of money flowing in and out of this market. The debt market is the biggest financial market, much bigger than the equity market. When those economic players, the smart money, when they started moving money away from the equity markets into bond market, that itself tells you that they are seeing much bigger risk in the real economy, and they're moving their money into the bond market as a safe haven, which is why the bond yield goes down, because there's a lot of buying happening in the bond market. So is this time different? Well, you ask yourself, what is the typical cycle? The cycle is when the earnings goes down, then the companies start laying off people, reducing their operational expense, which triggers the unemployment data goes up, which triggers the spending contraction, which means GDP contraction, which means Federal Reserve start cutting rates, which will trigger the yield curve gets uninverted because Federal Reserve is trying to bring the short-term rates down, which will make the yield curve uninverted, which means the smart money is leaving the equity markets, going into the bond market, and then cycle repeats itself. That's the typical cycle, and it has always played like this in the previous recession. I don't know how this time is going to be different. So what do we do now? The reason I'm telling you this because I'm going to give you an alternative view about the market that you don't see in the mainstream media. And the reason I'm telling you this is so that you can make an educated decision about your own portfolio. Okay? You don't have to listen to me alone. You have to listen to everybody. Okay, and then draw conclusions, connect the dots to understand what's happening in the market and how you can protect yourself from any downside risk and adjust your portfolio accordingly. That's the whole purpose of my channel. That's the whole purpose of this video, giving you enough information so that you can connect the dots, make your educated decision, and protect yourself. Anyway, if you like this video, give me a thumbs up and subscribe to my channel, and also check out my newsletter that I sent out on weekly basis. Let me know what you think about that, and I'll see you in my next video. Take care. If you are an investor in the US, in Canada, or in Europe, and you are considering investing into Dubai real estate market, this video is for you because we have a platform called Stake, which allows you to invest into the residential real estate market and start earning rental income right away without going through a lengthy documentation process or coming up with a heavy down payment. Stake is built upon the concept of crowdfunding. So it is democratizing the entire investment strategy and allows you to own a single unit of the entire investment portfolio. So you don't have to own the entire property, right? You can be part of the pool that can actually own a piece of property, a piece of real estate. So that allows you to start with as low as 2,000 dirhams, and you can slowly ramp up. So as you start investing into it, you can not only own a bit of real estate, but you also get a portion of the rental income on monthly basis. So it's a passive investment strategy, diversifying your portfolio from traditional North American or European markets into Dubai, which is hustling and bustling and growing very fast, and allows you to build your wealth over time. So don't delay. There is a link down there in the description. If you click on this, it will give you free 200 dirhams in your account right away to start with, and you can thank me later.